Chapter 10, Translation of Foreign Currency Financial Statements. So Chapter 9 was Transactions. Chapter 10 is Translations. So in the event of a consolidated group with a U.S. parent that has foreign subsidiaries, then there are two steps that the parent must take in order to consolidate. First, the foreign financial statements must be converted to U.S. GAAP. So in today's environment, most foreign entities are going to be presenting their financial statements at the foreign reporting standards. And so you first have to convert that, whatever changes, into U.S. GAAP. So not use the International Financial Reporting Standards. And then secondly, those statements are also going to be in a foreign currency. So you need to then translate the statements into US dollars. And that's what this chapter is going to be about. So there are two theoretical issues: what translation method should be used, and where should this adjustment be reported on the consolidated financial statements. So there are two ways of applying exchange rates. We can either do them historically, when the initial transaction occurred, or we can use the current exchange rate. So the exchange rates are going to generate depending upon which method we use, they're going to generate adjustments, translation adjustments, in order to get the balance sheet to balance. So the two major methods are the current rate or the temporal method. So these are the two. The current rate method is the assumption that the foreign operative is a currency asset, and we will reflect the translation adjustment as part of our stockholders' equity in the consolidated financial statements. And then the current rate method is also generating risk, but the exposure is equal to the net assets minus essentially their net worth, their stockholders' equity section. So which method do we use? Well, whether we use the temporal method is that all assets and liabilities are going to be carried and translated at their historical rate. All right, so all of the assets are translated year in and year out at the financial statement date based upon their historical rates. So when we bought property, plant, and equipment, when we bought inventory, when we valued accounts receivable, and the like. All right. Same with their liabilities. So when did we go into debt? When did we borrow the money? And the like. So the major issue with that is that there's a translation adjustment required, and that is reported. It's not taken to the income statement. It is reported in the stockholders' equity as a section there. All right, so what is as the temporal method requires the historical, whereas the current rate method uses the date at the balance sheet, the current spot rate at the balance sheet. So what is and then we have gains and losses on sale. Don't put that. So what method do we have to use? Well, it's derived by what is the functional currency. So the functional currency is the US dollar. Then we translate using the temporal method. Gains and losses are taken currently to the financial statement. If the foreign currency, the functional currency, is the foreign currency, then we use the current rate method, and it falls under other comprehensive income in the stockholders' equity section. So what's the determination of functional currency? So what do they do with their cash flow? Do they primarily record cash in the U.S. dollar or the subsidiary's currency? What is the sales price? What is the sales market? Do they actively sell locally, or are they selling mostly back to the parent company? So is it a subsidiary who supplies nothing but a subassembly or a raw material to the parent company, and that's their only transaction, and all of those transactions are then dealt with in US dollars? Or do they sell locally? I mean, is it a local McDonald's in Beijing or something like that? So what is it? What are the expenses? Are they paying their employees in local currencies? Are they settling all of their accounts, operating account payables in the local currency, or are they doing it in the parent company? All right. So the current rate method is going to be the most predominant method, and that's the one we're going to focus on. That's the one you're going to be tested on for the final exam. And so this one is that we're going to use the current rate to translate all assets and liabilities. The stockholders' equity common stock is going to be translated at its historical, when the initial investment was made. And then I'll go through in the examples that I do how we go about feeding retained earnings. On the income statement, sales and expenses are assumed, unless otherwise noted, are assumed to occur evenly throughout the year. So we use a blended, what was the average exchange rate throughout the period. And if there is a transaction, a major loss or a major expense that has been incurred, and we know the date at which that has occurred, then we translate that historically. Dividends on the statement of retained earnings are the date that the dividend was declared. All right. So all revenue and expenses are translated at a weighted average exchange rate. If there is a gain or loss at a specific point in time, then we use the spot rate on that date. Depreciation and amortization use average. Translations of income statement for the year taken is then driven down to the retained earnings. So we use the value of beginning retained earnings from last year's financial statement. We add in the net income that we just calculate. Dividends are exchanged at the historical rate, and that will give us a balance for retained earnings at the end of the period. All assets are done at the spot rate at the balance sheet date. So all assets, cash all the way through intangibles, are what the current rate at the balance sheet. Liabilities are done the same way, and then we have the retained earnings calculation from the statement of retained earnings. That's going to give us the assets are no longer going to equal the liabilities plus stockholders' equity, because the stockholders' equity section was translated at a different rate, with the common stock at historical, and then the retained earnings coming down from its calculation in the statement of retained earnings. At that point, you have a translation adjustment that under the current rate method is taken to other comprehensive income. And it's whatever amount is needed in order to balance the two sides of the equation. So a quick example, we paid on January 1, 2016, we bought for 25,000 million pounds, 100% of this subsidiary in Great Britain. At that date, we had this as far as our assets, our liabilities, common stock, and retained earnings. So there was a 2.3 excess of fair value over book value, and that was all attributed to undervalued land. So then, 2 years after the acquisition date, we have this. So we have, here's our assets, our liabilities, common stock, retained earnings at January 1, sales, cost of goods sold, depreciation, other expenses, and then we have a dividend that was declared on 6/30. So here's the various exchange rates. We have in 2016, on the date of the acquisition, an exchange rate of 1.51. This is to the US dollar, so this is a indirect, so we're going to multiply the foreign currency. I'm sorry, this is a direct. We're going to multiply because the to the US dollar and translate that. Then we have an average for the 2017. We have also a specific spot rate of $1.58, June 30th, which is the date of the dividends. So we're first going to take all of this, and so we're going to take this 600,000, multiply it by the 1.53 current rate, and we're going to translate all assets and liabilities. The historical rate of 1.53 for the common stock, we're going to multiply that out, and that gives us the US dollars. Retained earnings came from last year's statement, so we don't have an exchange rate. We just, whatever retained earnings was calculated at the 12/31/2016, which in this case was $5,771,000. Then we're going to translate the sales, cost of goods sold, depreciation, and other expenses all at an average rate. And then we'll get the dividends at its historical rate. And then the cumulative translation adjustment, in order to balance all that out, winds up to be $401,500, a credit to the other comprehensive income in stockholders' equity. So here's the retained earnings from the prior. Well, this was the first one. We took that. We used the average for net income, and that gave us the 5,771 retained earnings calculation. So we're going to translate all of the net assets, and this gives us that 401,500 credit. So here's our worksheet for consolidated purposes. So once we translate that and get Buford in US dollars, then we can do the SADI entries, the S, the A, which is just the land, A entry, D is the dividend, I is the income, and then we have a translation adjustment that will also go to the investment in Buford, and that goes down in this other comprehensive income. And that's it. So I'll do problems for both 9 and 10 next.